Welcome to another episode of Ask Finance LendTech TV. Today, we're exploring a topic that's shaping the real estate and banking sectors in the Middle East, the evolving mortgage regulations in Qatar and Kuwait. These regulatory changes are creating both challenges and opportunities for banks, and understanding how to navigate them is crucial. Joining me today is Chris Kneen, Chief Commercial Officer at Ask Finance, and an authority on digital lending transformation. Thank you for being here, Chris.
Hey, John. Yeah, thanks for having me. Yeah, I'm really excited to be here and looking forward to diving into these topics, specifically around how banks can adapt to these regulatory changes, whilst at the same time, the need to really optimize their operations and risk management strategies.
Let's start with Qatar. The country implemented new mortgage regulations in July 2023, and they've already had a significant impact. Could you walk us through these changes and their effects on the market?
Sure, happy to, John. The Qatar Central Bank, or QCB, has recently introduced new rules aimed at stabilising their real estate market and promoting responsible lending. Some of these changes include specific loan-to-value, or LTV ratios, and tenure limits. For example, Qatari citizens can now secure up to 80% LTV for homes valued up to 6 million rial, with loan terms extending up to 30 years. Whereas if you're an expat, you can be offered a slightly lower LTV limit with shorter tenures. Additionally, the QCB has also imposed debt burden ratio caps, which will prevent borrowers from becoming overextended. What this has resulted in is a huge surge in mortgage activity. So what we saw in the first quarter of last year is transaction volumes jumped by 90%, meaning in Q1 2024, we saw nearly 17 billion rial of transactions, whilst this demonstrates a pent-up demand, it's also led to a rise in non-performing loans, or NPLs, which has increased to by nearly 2%, so from 1.9% in 2019 to nearly 4% in 2023. So what this really highlights is that there's a real need for robust risk management and improved compliance.
That's quite a jump in activity and risk. Would you say that the rise in NPLs is one of the biggest challenges banks in Qatar face in this environment?
Definitely. Rising NPLs are a major concern, which shows that the need for increased sophistication of risk strategies and more robust underwriting processes is of paramount importance. On top of this, compliance with the central bank's LTV and debt burden ratio caps require much more dynamic enforcement, making the need for automated compliance and reporting tools super important. On top of that, the surge in loan applications will have put a big operational strain on the banks. So making sure that they invest in the right digital loan platforms around origination and customer management is critical for streamlining processes and reducing the need for manual work.
Let's turn to Kuwait. The country is on the verge of significant mortgage reforms set to take effect this 2025. What can we expect from these changes?
Yes, John. This new legislation in Kuwait aims to address a long-standing housing shortage and invigorate their real estate market by allowing commercial banks to offer mortgages. What banks will be able to provide is loans up to 200,000 dinar, with the government subsidising interest on the first 70,000 dinar. And loan repayment periods will extend up to 25 years. And the regulator has allowed a debt-to-income ratio cap to be increased from 40 to 50%. One of the most impactful provisions is the introduction of foreclosure rights. And these foreclosure rights will enable banks to seize properties in case of default. What this means for the banks is that it does reduce their credit risk, though, and will encourage more lending activity. And we've seen over 100,000 pending housing applications reported. And so our banks are anticipating significant loan growth, which is projected to increase by 4% annually.
Those reforms sound promising, but they also bring challenges. What are the key issues banks in Kuwait need to address?
Yes, pricing uncertainty is a major concern, with government subsidies complicating the profitability predictions. Banks must be equipped to adopt flexible pricing strategies and predictive financial models to help navigate these uncertainties. This shift to a more competitive mortgage market in Kuwait has also brought new risks, with the banks there needing to invest heavily in enhanced AI-driven credit assessment tools. On top of this, they've had a large backlog of mortgage applications to process, which has really driven home the need for scalable operations. They've also had to look at how they can advance their loan processing solutions. Things like automated document verification and AI-powered credit scoring have been adopted and are helping manage demand without sacrificing speed, compliance or accuracy. The last point is that the increased DTI cap raises concerns about borrower affordability, making the need for enhanced financial analysis really essential for evaluating repayment capacity.
Digital transformation seems crucial for overcoming these challenges. How can the right digital lending solution support banks in this regulatory landscape?
Good question, John. Yes, a robust digital lending solution like the Axe Credit Portal, or ACP, is a real game changer. What ACP does is automate these key processes, things like document verification, credit assessment, and approval workflows, which reduces loan approval times and operational workload on the bank. It also ensures real-time regulatory compliance and automatically enforces the LTV ratios, the DTI caps, and the debt burden limits that the banks are now facing into. On top of that, ACP's advanced risk management tools use predictive analytics and fraud detection to help minimise non-performing loans. Plus, our flexible pricing engine helps banks adapt to regulatory shifts, while AI-driven insights personalise mortgage offers, enhancing the customer's experience and satisfaction and resulting for the banks in much improved conversion rates.
This has been a very incredibly insightful discussion. Thank you, Chris, for sharing your expertise. Before we wrap up, any final advice for banks navigating these regulatory changes?
Yeah, thanks, John. I've enjoyed it too. I think my last bit of advice, though, would be that banks should prioritise a few things. Firstly, end-to-end automation, advanced risk management, but also ensuring they have flexible pricing strategies in place. On top of that, they should be thinking about how they leverage comprehensive digital solutions that exist out there, creating ecosystems, hopefully using tools like ACP, because what we can help with is ensuring compliance, help our banking customers mitigate their risks, and at the same time making sure that they're making profitable decisions. And from a customer's perspective, we're helping the banks deliver those superior customer experiences at the same time.
Well said. Thank you again. And thank you to our listeners for tuning in. Stay tuned for more expert insights on Axe Finance LendTech TV. For more information or to reach out to our solution experts, visit axfinance.com. We'll be here to help you make informed decisions in the world of digital lending technology.